In this video, I will tell you guys the 5 trading mistakes that are very common in day trading, and I wish someone told me when I started out, because these 5 things would have saved me thousands of dollars 3 years ago. So let's get straight into it. The first mistake is to have a very strict stop loss, because believe me or not, when I started out in February 2019, I was not having a strict stop loss. From February to June 2019, for the first 5 months of my trading journey, I was dabbling between the Australian market and the US market, just testing out the waters. And if you guys saw my trading journey video, you guys know how I started out trading. But from February to June, for the first 5 months of my trading journey, I was not having a stop loss. I was making $600, losing $400, losing $1,000 on a few days, and my account was worth around $3,000 to $5,000. So that means I was losing 20 to 40% and making 20 to 40% in one single day, and obviously that is not sustainable. But starting 1st of July 2019, I mentioned everything in my trading journey video, I had a very strict stop loss. The platform I was using back then, and I'm still using that platform, Dash Trader Pro, that has a very important and very good feature for most of the day traders out there, and especially for beginner traders, to have a max daily stop loss. So when I started out, my max daily stop loss was only $20. So what that means is that if I lose $20 for the day, I won't be able to place any more trades on that platform, and that saved me a lot of money when I was learning about day trading. So I started risking $20, then I increased my risk to like $30, $40. I remember vividly increasing my risk from $40 to $60 was a big achievement for me personally, and that was a huge step in my trading journey. But these days I pay like $60 in commissions every single day. But the point is that it's going to be a very long journey. So risking $100 or $500 every single day on a $5,000 account is not sustainable, because you need to learn about day trading. You need to learn the art first. I see a lot of traders with like $4,000 to $5,000 account. They are risking $500 to $600 every single day, which is like 10 to 20% of their account, which is insane. So what I would do personally as a beginner trader is that I would maybe risk 1 to 2% of my account if I'm trading stocks, and if I'm trading options, the maximum I would risk on one single day will be 5%. That is like worst case scenario, but this will vary from trader to trader depending on your personal situation and how much money you can afford to risk every single day. But at the end of the day, don't gamble 40 or 50% of your account on one single day, because it's not worth it in the long run. Having a very strict stop loss on especially small accounts is very important, because I will tell you guys one important amazing thing about mathematics. For example, if you have $1,000 account, right? So the mathematics is not fair in this, in my opinion, right? If you have $1,000 account, you lose $400 on that account, maybe in one day, you drop your account by 40%. At the end of the day, your account value is $600. To increase that same account from $600 to $1,000, you need to gain back 66.66%, right? Because 66.66% of $600 is $400, but 40% of $1,000 is $400. And that is the reason mathematics is not fair. You have to treat it like a business and focus on protecting your downside, especially as a beginner trader. Now let's jump on to the second mistake. The second mistake is to start with the paper or demo account. This is very important, because when I started out, to be honest, I haven't ever traded on a paper account or demo account in my life. Maybe for a few days in between when I was trying out new strategies. But if I could go back in time and change this thing about my trading, I would definitely do that, because for the first few months of my trading journey, I lost a lot of money by just learning about the platform, because you need to learn how to buy, how to sell, how to trade options in my case, how to choose the right strike prices, how to look at the spreads and the Greeks and everything. So you need to spend a lot of time to learn how to use the platform. So these trading mistakes are very, very common in the trading world, where you click the wrong hotkey, you lose a lot of money, or maybe instead of buying, you click sell and you lose a lot of money. That's why it's very important to start with the paper or demo account. I strongly believe that these paper and demo accounts won't make you a consistent trader, but when you are started out day trading, you won't be consistent. That's the first thing, right? The second thing is that if you start with a paper or demo account, it will give you a lot more confidence on your strategy. The important thing is that if you can't make money on a paper or demo account, it's a guarantee that you won't be able to make money on a live account. On the other hand, if you are able to make money on a paper account, you might make money on a live account as well. So what I would recommend is to spend at least 1 to 2 months when you start out as a beginner trader on a paper account to learn about the platform, how to place your orders and everything like that, and what stock market is, to learn more about the stock market. And even as an experienced trader, if you want to test out new strategies, for sure go to a paper account account, test out your new strategies, and then use those strategies on the live account. The third mistake that I see a lot of traders making, and especially beginner traders, is to use too many indicators, which won't make you a consistent trader. I can't stress enough the importance of not being dependent on indicators, because I made a separate video on this topic as well. That video will be linked at the end of this video. But in that video, I explained that using too many indicators won't help you become a consistent trader, and that's the proven fact of day trading. And that is how I was able to find consistency in the stock market when I stopped being dependent on indicators for my trading. As the name suggests, indicators should only be used to indicate your trading journey. Your trading should be based on raw price action, the volume, market depth, looking at the tape, looking at the supply and demand zones, and looking at the support and resistance levels. Again, if you guys want to learn more about this very common mistake in the trading world, go ahead and watch the video I made specifically on this topic, because this is a very common mistake in the trading world. That video will be linked at the end of this video. Now coming to the fourth mistake, and this is also very common with specifically I would say beginner traders and not very experienced traders, is that chasing a stock when the stock has already moved past its ATR. ATR is called the average true range. That is how much a stock moves on an average on a daily basis. For example, if ATR of a stock is like $50, and if you are taking a bull flag when the stock has already moved $60 from the low of the day to high of the day, that bull flag or maybe the bear flag won't work most likely. Now let's take an example of Tesla and explain this point with the help of a chart. But before we do that, I would really appreciate a thumbs up, and if you guys are new, subscribe to my channel and hit the bell notifications to learn more about day trading. So here's the one-day chart of Tesla in front of you. I already have the ATR indicator that I usually hide, but I look at the ATR once a week. But to add this indicator, you have to go in indicators and just search for ATR and add this indicator and use the default value. So you can look at the ATR on the left hand side of the scale, but what I usually do is that I drop down this indicator box and you can look at the value on the left hand side. This is on the red, right? So the ATR on Tesla has been hovering around $58, $57, $59, $60, $55 or something like that. So that means these days on an average, this stock is moving around $55 to $60 every single day. Now let's take an example of Tesla again and look at the 5-minute chart and explain why you should not take a stock when it's moved past its ATR for the day. So on this day, that was on 26th of May. The difference between the low of the day and the high of the day was around, I would say, $60 and $65 until this point. That was approximately 12:30 p.m. right here. So now after moving $65 for the day, approximately $60, the ATR of Tesla is $60. It has already moved $65 for the day. I'm pretty sure a lot of traders, and especially I would say beginner traders, they will look at the bull flag right here. They miss the initial push towards the upside right here. They will enter right here, but the stock dumped against them. This is because the stock has already moved past its ATR. So that means a lot of traders who entered right at the bottom, or maybe who entered here, swing traders, day traders, and all the other traders, they will start seeking their profit taking right here. So this means when the beginner traders are thinking to enter their position, or maybe they entered their position, the more experienced traders, they are now selling their position because they know that the stock is very extended on the daily chart. Let's now break down the fifth and the final mistake, that is jumping between strategies and trading style. This is very common, I would say, with beginner as well as experienced traders, because until this day, if I am on a red streak, I try to jump between strategies, because that is very common. If you think that something is not working in your favor, you will try to change your strategy, and that is not the wisest thing in my opinion. Now don't get me wrong, I'm for sure saying to adjust your strategy and change your trading style depending on the market conditions. Jumping between strategies is not the wisest thing to do as a trader, because listen to this sentence, you will forever be a beginner trader if you keep jumping between strategies, because you won't give that one strategy or trading style enough time to become experienced with that strategy or trading style. So this means stick to your strategy, but keep tweaking your strategy here and there so that you are profitable in the current market conditions, right? For example, I was a breakout trader. I used to trade the same strategy back in 2020 and early 2021, that is like bull flag, bear flags and all these strategies, but I used to enter at the breakout. So these days I have tweaked my strategy based on the current market conditions, where I enter on the pullback and I try to catch the breakout instead of entering at the breakout. So these are the small changes you need to keep on making every single day if you want to sustain in the stock market, because the stock market keeps on changing. But what is not the wisest thing to do is, maybe for example you have been trading shares for maybe 2 years, then you change to futures all of a sudden because you are not able to make money trading shares, and then after a few weeks you change to trading options, and then maybe after a few weeks you start trading cryptos. So this means you will forever be a beginner trader, because even though you might be able to trade cryptos after being trading stocks for the past 2 years, but you will be a beginner crypto trader. Yes, the basics are the same, the charts are the same, the support and resistance lines are the same and everything like that, but at the end of the day they are different asset classes traded by different bunch of people. So the market sentiment, how they move on a daily basis, will be completely different. That's why don't change your trading asset class, trading strategy just because you were not able to make money for a few weeks. You need to give that one thing enough time to be experienced with that one thing so that it can pay you in the long run. Try to be a master of the one thing and not multiple things. Now for traders who stayed until the end of this video, there's one bonus point, that this ain't a get rich quick scheme. You have to work on creating a solid base and solid root for yourself so that you can build up on that. For example, you are able to grow your $5,000 account to maybe $50,000 on one single trade, but I can guarantee you that it won't take you a lot of time to lose that whole amount of money, because the way you took it towards the upside was kind of gambling and not trading. You need to work on creating a solid base. That means focus on risk management, account management, work on developing your trading strategy, and slowly and steadily try to grow your account so that even if I give you a $100,000 account, you will be able to grow that account steadily and consistently because you have solid base and solid roots. That's it guys, but before you go, make sure that you guys give this video a thumbs up because it helps out the channel a lot to grow and reach new traders out there. And if you are new, don't forget to subscribe and hit the bell notifications to learn more about day trading and to stay up to date with my trading journey. If you guys don't follow me on Instagram, that is a must follow because I post a lot of good day trading content and a few behind the scenes of a day trader on Instagram as well. The link will be in the description box below. Thank you for watching and I will see you guys in the next video. A quick sneak peek of my next video.